All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another financial news story you can afford to ignore. 72 hours ago, the Federal Reserve made a quiet adjustment to its reverse repo facility that went almost completely unnoticed by the mainstream financial media. The overnight reverse repo balance dropped by $47 billion in a single session, falling to its lowest level since May 2021. That might sound like technical jargon, but let me translate what this actually means. The Fed just drained $47 billion of liquidity from the financial system in one day, and they did it without a press release, without a statement, and without any explanation to the public. This is not a routine adjustment. This is not normal monetary policy. This is the kind of quiet mechanism that precedes liquidity freezes, credit market seizures, and the kind of systemic stress that catches 99% of investors completely off guard. When liquidity dries up in the banking system, the first thing that happens is not a crash. It's a pause. It's a moment where institutions stop lending to each other because they're unsure who's solvent and who's sitting on losses they haven't disclosed yet. And by the time that pause becomes public knowledge, by the time CNBC is talking about it, the exits are already closed. You're already locked in. Over the next 25 minutes, I'm going to walk you through exactly what this liquidity drain means, why the Fed is doing it now, and why the 72-hour window before a potential freeze is the most critical period for repositioning your wealth. I'm going to show you the historical precedents, the mechanical breakdown of how liquidity stress cascades through the system, and most importantly, the three asymmetric moves you need to make right now to protect yourself and potentially profit from what's coming. This is not about fear. This is about pattern recognition, preparation, and understanding the game being played at the institutional level. So turn off the distractions, grab something to write with, and let's break this down step by step, because what I'm about to show you will change how you think about where your money is sitting right now. Before we dive into what's happening right now in the Federal Reserve's balance sheet, you need to understand the foundational framework that governs every major liquidity crisis in modern financial history. I call this the asymmetric liquidity framework, and it's built on one simple truth that most investors completely ignore. Liquidity is not constant, it's not guaranteed, and when it disappears faster than anyone expects. The system we operate in today is built on what's called fractional reserve banking, which means that banks only hold a tiny fraction of their deposits as actual cash. The rest is loaned out, invested in securities, or tied up in illiquid assets like commercial real estate loans and long-duration bonds. This works perfectly fine in normal conditions because not everyone tries to withdraw their money at the same time. But the moment confidence cracks, the moment institutions start questioning the solvency of their counterparties, the entire mechanism seizes, and that's when liquidity, the lifeblood of the financial system, evaporates. The reverse repo facility is one of the Fed's key tools for managing short-term liquidity. Here's how it works in plain English. Banks and money market funds that have excess cash can park that cash overnight with the Federal Reserve in exchange for Treasury securities as collateral. It's essentially a safe place to store money and earn a small return. When the reverse repo balance is high, it means there's a lot of cash sitting on the sidelines, not being deployed into the real economy. When that balance starts dropping rapidly, it means institutions are pulling cash out of the Fed's facility and either deploying it elsewhere or using it to cover obligations. Now here's the critical part. A gradual decline in reverse repo balances is normal as liquidity flows back into the banking system, but a sudden sharp drop of $47 billion in a single session is not normal. It's a signal that something is pulling on liquidity hard and fast. And when you combine that with other stress indicators we're seeing in the credit markets, the Treasury market, and the commercial real estate sector, the picture becomes very clear. We are entering a liquidity squeeze, and the 72-hour window we're in right now is the early warning stage before it becomes obvious to everyone else. The core thesis of this video is straightforward but critical. We are witnessing the early stages of a coordinated liquidity drain that will force institutions into a position where they have to choose between maintaining solvency and maintaining liquidity. The Fed's quiet adjustment to the reverse repo facility is not an isolated event. It's part of a broader tightening cycle that has been accelerating since the regional banking crisis of early 2023. And it's happening at the exact moment when over $1.2 trillion in Treasury debt is rolling over in the first quarter of 2026. This creates a perfect storm where the government needs to issue massive amounts of new debt, banks need liquidity to absorb that debt, and the Fed is simultaneously pulling liquidity out of the system. The institutions that recognize this mismatch and act now will preserve capital. The institutions and individuals that wait for confirmation from the mainstream media will be the ones holding illiquid assets when the freeze hits. This is not about predicting a crash. This is about understanding the mechanical sequence of events that leads to systemic stress and positioning yourself on the right side of that sequence before it becomes irreversible. Now let's turn to history, because if you don't understand how liquidity crises unfold, you're going to misread every signal the market is giving you right now. The first parallel we need to examine is the liquidity crisis of September 2008, specifically the week leading up to the collapse of Lehman Brothers. Most people remember Lehman's bankruptcy as the moment the financial crisis went public, but the real breakdown happened in the repo markets 3 days before Lehman filed. The repo market is where financial institutions borrow cash overnight using securities as collateral. It's the plumbing of the entire financial system. In mid-September 2008, the repo market began to freeze. Institutions stopped lending to each other because they didn't know who was holding toxic mortgage-backed securities and who was solvent. The spread between the repo rate and the risk-free rate, which is normally just a few basis points, exploded to over 300 basis points. That's a 300% increase in the cost of overnight funding in less than 72 hours. When that spread blows out, it means institutions are terrified. They're demanding massive premiums to lend money even on a secured basis because they're not sure they'll get their money back. And here's what's critical. The Federal Reserve saw this happening in real time. They knew the repo market was seizing up, and they tried to inject liquidity through emergency facilities. But the problem wasn't the amount of liquidity, it was the lack of trust. No amount of Fed intervention could force institutions to lend to counterparties they believed were insolvent, and so the freeze accelerated. By the time Lehman filed for bankruptcy on September 15th, the liquidity crisis had already metastasized into a full-blown solvency crisis. The lesson from 2008 is not that liquidity crises cause insolvency, it's that they expose insolvency that was already there, hidden by easy credit and cheap funding. And once that insolvency is exposed, the cascade is unstoppable. The second historical parallel is the Treasury market liquidity crisis of March 2020. This one is even more relevant to what we're seeing today because it happened in the supposedly safest, most liquid market in the world, the United States Treasury market. In mid-March 2020, as the COVID pandemic was escalating and global markets were in freefall, something shocking happened. The Treasury market, the bedrock of global finance, experienced a liquidity crisis. Bid-ask spreads, which measure the difference between what buyers are willing to pay and what sellers are asking, widened to levels not seen since the 2008 crisis. Trading volume spiked, but prices were moving erratically because there weren't enough buyers to absorb the selling pressure. Hedge funds and institutional investors were being forced to liquidate their Treasury holdings to raise cash for margin calls in other parts of their portfolios. And normally the primary dealers, the big banks that are required to make markets in Treasuries, would step in and provide liquidity. But in March 2020, they didn't. Why? Because the primary dealers themselves were stretched. Their balance sheets were already full of Treasuries from previous rounds of quantitative easing, and they didn't have the capacity or the willingness to absorb more. This created a doom loop. Sellers needed liquidity, buyers were absent, and prices started falling even though Treasuries are supposed to be the ultimate safe haven asset. It took the Federal Reserve stepping in with unlimited quantitative easing, committing to buy Treasuries in unlimited quantities to stabilize the market. But here's the key insight. For 72 hours before the Fed announced that intervention, the Treasury market was on the brink of a complete breakdown. And if you were holding Treasuries or any asset that relied on Treasury market liquidity for pricing, you were at risk of being unable to sell at any reasonable price. The lesson from March 2020 is that liquidity can disappear even in the deepest, most liquid markets when institutional stress reaches a critical threshold. And when the Fed is the only buyer left, you are entirely dependent on their willingness to intervene. That's not a market, that's a controlled system. And right now, with the reverse repo facility draining $47 billion in a single day, we're seeing the early signs that institutional stress is building again. So let's talk about what's happening right now in real time, and why the mechanics of this liquidity drain are so dangerous. The reverse repo facility, which peaked at over $2.5 trillion in late 2022, has now fallen below $200 billion. That's a drawdown of over $2.3 trillion in less than 3 years. Now, the mainstream narrative is that this is a good thing because it means liquidity is flowing back into the banking system and the real economy. But that narrative ignores a critical reality. The liquidity that's leaving the reverse repo facility isn't being deployed into productive lending. It's being absorbed by Treasury issuance, by banks shoring up their balance sheets, and by money market funds repositioning for higher short-term rates. In other words, the liquidity is disappearing into obligations, not opportunities. At the same time, the United States Treasury is issuing record amounts of debt. In the first quarter of 2026 alone, the Treasury needs to roll over $1.2 trillion in maturing debt and issue an additional $400 billion in new debt to fund the federal deficit. That's $1.6 trillion in gross issuance in just 3 months. And here's the problem. The traditional buyers of that debt, foreign central banks, domestic banks, and institutional investors, are either reducing their holdings or demanding higher yields to compensate for the risk. China has reduced its treasury holdings by over $300 billion in the last 2 years. Japan, historically one of the largest foreign holders, has been selling treasuries to support the yen. And domestic banks are constrained by capital requirements and the fact that they're already holding record amounts of treasuries on their balance sheets from previous rounds of quantitative easing. So who's left to buy? The answer is money market funds and the Federal Reserve itself. And when the Fed drains liquidity through the reverse repo facility at the exact moment the Treasury is issuing massive amounts of debt, you create a structural shortage. There's not enough cash in the system to absorb the supply of treasuries without yields rising significantly or the Fed stepping in as the buyer of last resort. And rising Treasury yields create their own cascade of problems. Higher yields mean lower prices for existing bonds, which means mark-to-market losses for banks, pension funds, and insurance companies holding those bonds. It also means higher borrowing costs for corporations, consumers, and the government itself, which accelerates the debt spiral. Now let's talk about the quiet mechanism that most people don't understand, and this is where the 72-hour window becomes critical. When liquidity stress starts building in the financial system, the first place it shows up is not in the headlines. It's in the overnight funding markets. Specifically, the secured overnight financing rate, known as SOFR, and the repo market. SOFR is the benchmark rate that replaced LIBOR, and it measures the cost of borrowing cash overnight using Treasury securities as collateral. Under normal conditions, SOFR trades very close to the Federal Reserve's target rate. But when liquidity gets tight, SOFR starts spiking above the target rate because institutions are bidding up the price of overnight cash. In the last 2 weeks, we've seen intermittent spikes in SOFR of 10 to 15 basis points above the Fed's target. These spikes are brief, lasting only a few hours before the Fed steps in with overnight repo operations to inject liquidity. But the fact that they're happening at all is a warning sign. It means there are moments during the trading day when the demand for cash is exceeding the supply, and institutions are scrambling to fund their positions. Now, combine that with the reverse repo facility draining $47 billion in a single day, and you start to see the pressure building. The Fed is pulling liquidity out through one door while institutions are demanding more liquidity through another. And the Fed's overnight repo operations, which are supposed to be a safety valve, are being used more frequently. This is the classic setup for a liquidity freeze. And here's why the 72-hour window matters. In a liquidity crisis, there is always a brief period before the freeze becomes systemic where institutions that are paying attention can still reposition. They can still sell assets at reasonable prices. They can still move cash to safer jurisdictions. And they can still access credit lines before they get pulled. But that window is measured in hours, not days. Once the stress becomes obvious, once the media starts covering it, the window closes. Credit lines get frozen, asset prices gap down, and liquidity disappears entirely. We saw this in 2008. We saw it in March 2020, and we're seeing the early signs of it right now. So what are the 3 asymmetric plays in this environment? And I'm going to be very specific about this because generic advice doesn't help you when the system is under stress. The first play is to reduce your exposure to assets that rely on liquid markets to maintain their value. This includes long-duration bonds, high-yield corporate debt, and liquid alternative investments like private equity or structured products. In a liquidity freeze, these assets become impossible to sell at anything close to their mark-to-market value. If you hold them directly, you're locked in. If you hold them through a fund, the fund may gate redemptions, meaning you can't get your money out even if you want to. The action here is to rotate into shorter duration, highly liquid assets. This means Treasury bills with maturities under 6 months, investment-grade floating rate notes, and money market funds that invest exclusively in government securities. These assets may not offer high returns, but they offer accessibility, which is more valuable than yield when liquidity disappears. The second play is to establish a position in physical precious metals as a systemic hedge. And I need to be very clear about what I mean by physical. I'm not talking about GLD or SLV, the ETFs that trade on exchanges. I'm talking about physical gold and silver bars or coins that you hold in your possession or in an allocated, segregated vault outside the banking system. The reason this is asymmetric is because gold and silver are the only assets that have zero counterparty risk. They don't depend on a bank, a clearinghouse, or a government promise. They're final settlement. And in a liquidity crisis, when trust between institutions breaks down, final settlement becomes the most valuable property an asset can have. Historically, gold has performed exceptionally well during liquidity crises, not because people suddenly love gold, but because they lose faith in the system's ability to honor its obligations. In 2008, gold was one of the only assets that held its value while everything else collapsed. In March 2020, gold spiked to new highs even as stocks cratered. And right now, with central banks around the world accelerating their gold purchases to record levels, the signal is clear. The institutions that manage sovereign wealth understand that the monetary system is under stress, and they're positioning accordingly. If you don't already have a meaningful allocation to physical gold and silver, the time to establish that position is right now, while liquidity still exists, to convert cash into metal at reasonable spreads. The third play is to build redundancy in your financial infrastructure. And this is something most retail investors never think about until it's too late. Redundancy means having multiple banking relationships, multiple brokerage accounts, multiple sources of credit, and multiple jurisdictions where you can access your wealth. Why does this matter? Because in a liquidity freeze, institutions protect themselves first and their customers second. If your bank is experiencing a run, they may limit withdrawals. If your brokerage is facing a margin call crisis, they may restrict trading or freeze accounts. If your credit line is with a regional bank that's under stress, they may pull that line without notice. This has happened before, and it will happen again. The action here is to diversify your counterparty risk. Open accounts at multiple institutions, preferably institutions of different sizes and geographic footprints. Keep enough cash in each account to handle near-term obligations, but don't concentrate everything in one place. If you have significant assets, consider offshore accounts in jurisdictions with strong rule of law and no history of capital controls. This isn't about tax evasion, this is about asset protection and optionality. And if you're a business owner or high net worth individual, establish credit lines now while you can, even if you don't need them. Because when liquidity freezes, those lines disappear, and having access to capital when no one else does is the ultimate competitive advantage. Now let's talk about the signals you need to watch over the next 72 hours, because this situation is dynamic and it's evolving in real time. The first signal is the overnight repo rate and SOFR. If we see sustained spikes above the Fed's target rate, especially spikes that last for multiple sessions or that occur at the same time each day, that's a red flag that institutional demand for cash is exceeding supply on a structural basis. The Fed will try to manage this with overnight repo operations, but if those operations keep getting larger or more frequent, it means the underlying stress is building, not resolving. The second signal is the behavior of money market fund yields. Money market funds are required to maintain stable net asset values, which means they have to be very conservative in their investments. If you start seeing money market funds breaking the buck, meaning their net asset value falls below $1 per share, that's a sign of severe stress in the short-term funding markets. This happened in 2008 with the Reserve Primary Fund, and it triggered a mass exodus from money market funds into FDIC-insured bank accounts. If we see that again, it means institutional confidence is collapsing. The third signal is credit default swap spreads on major financial institutions. Credit default swaps are essentially insurance contracts that pay out if a company defaults on its debt. When CDS spreads widen, it means the market is pricing in a higher probability of default. Right now, CDS spreads on major U.S. banks are elevated but not critical. But if we see a sharp widening, especially for institutions with significant commercial real estate exposure or Treasury holdings, that's a sign that the market is starting to price in solvency risk, not just liquidity risk. And once solvency concerns enter the picture, the game changes completely. The fourth signal, and this is the most important one, is the Federal Reserve's response. If the Fed announces an emergency liquidity facility, if they restart quantitative easing, or if they make any unscheduled statement about supporting the financial system, that's not reassurance. That's confirmation that the stress has reached a level where they have to intervene to prevent a systemic breakdown. And by the time the Fed makes that announcement, the 72-hour window has closed. The asymmetric opportunity to reposition before the crowd recognizes the crisis will be gone. Let me give you a concrete example of how this plays out in practice. In March 2023, during the regional banking crisis that took down Silicon Valley Bank and Signature Bank, there was a 72-hour window between the first signs of stress and the full-blown run that forced regulators to step in over a weekend. On Wednesday, March 8th, Silicon Valley Bank announced it had sold a portfolio of securities at a $1.8 billion loss and needed to raise capital. The stock dropped 60% in a single day. That was the signal. On Thursday, venture capital firms started telling their portfolio companies to pull their deposits out of SVB. Billions of dollars were withdrawn in a matter of hours. That was the cascade. By Friday, the bank was insolvent and regulators shut it down. The entire sequence took 72 hours. Now, the investors and institutions that recognized the signal on Wednesday and moved their cash out of SVB or reduced their exposure to other regional banks had time to act. The investors who waited for confirmation, who thought it was just a rough day for one bank, were locked in when the freeze hit. This is not about being paranoid. This is about understanding that in a highly leveraged, interconnected financial system, stress propagates faster than information. And the window to act is measured in hours, not weeks. So what do you do right now? And I mean this week, not next month. First, you need to audit your liquidity. Go through every account, every asset, every position, and ask yourself one question. If I needed to convert this to cash in 24 hours, could I do it without taking a significant loss? If the answer is no, you have a liquidity risk. The action is to either reduce that position or hedge it in a way that gives you optionality. Second, you need to assess your banking counterparty risk. If you have deposits above FDIC insurance limits in a single institution, especially a regional bank with significant commercial real estate exposure, you are taking on uncompensated risk. The action is to spread those deposits across multiple institutions or move them into Treasury-only money market funds, where the credit risk is on the U.S. government, not a bank. Third, you need to establish your precious metals position if you haven't already. The window to buy physical gold and silver at reasonable premiums is still open, but it's narrowing. Dealers are reporting increasing demand and tighter supply, especially for smaller denominations like 1-ounce coins. The action is to work with a reputable dealer, take delivery, and store the metal in a secure location outside the banking system. Fourth, you need to stress test your credit lines and access to capital. If you have a home equity line of credit, a business line, or any revolving credit facility, draw on it now even if you don't need the cash. Put that cash in a safe liquid account, because if liquidity stress escalates, banks will pull those lines and you won't have access when you actually need it. Fifth, and this is the most important one, you need to stay informed and stay flexible. This is not a static situation. The Fed's balance sheet is updating daily. The Treasury issuance calendar is public. Credit spreads, repo rates, and money market fund flows are all published in real time. You need to be monitoring these data points, not once a week, but daily. And you need to be willing to act on what the data is telling you, even if it contradicts the narrative you're hearing from mainstream sources. Here's the question I want you to answer in the comments, and I read every single one. How much of your liquid net worth is currently in assets that you could not convert to cash in 24 hours without taking a significant loss? I'm talking about illiquid alternatives, long-duration bonds, concentrated equity positions, anything that depends on a functioning market to exit. Give me a percentage and let me know if you're taking steps to reduce that exposure or if you're comfortable with the risk. I want to hear from you because the diversity of perspectives in this community is what makes it valuable, and I want to understand how people are thinking about liquidity risk in real time. And if you found this breakdown valuable, if you understand why the 72-hour window matters and why the Fed's quiet liquidity drain is not a routine adjustment, then I need you to do two things right now. First, smash that subscribe button and turn on notifications because this channel is dedicated to tracking the signals that the mainstream media ignores. We focus on the data, the mechanisms, and the asymmetric opportunities that emerge when the system is under stress. Second, share this video with anyone you know who has significant assets in the financial system. The people who are going to be hurt most by a liquidity freeze are the ones who don't see it coming, who trust that the system will always provide exit liquidity, and who find out too late that in a crisis the exits close faster than anyone expects. This is not about creating fear. This is about creating awareness. And awareness is the difference between being caught in the freeze and being positioned to navigate it. The Fed just drained $47 billion of liquidity in a single session. The 72-hour window is open. The signals are flashing. And the only question left is whether you're going to recognize what's happening and act while you still have time, or whether you're going to wait for confirmation and find yourself locked in when the system seizes. I'll see you in the next one. Stay sharp, stay liquid, and stay ahead of the curve.